Dan, good to have you back. Welcome.
Thanks, Sarah. How are you?
Doing all right. You know, I have focused on Chegg a lot lately because you're sort of an interesting read on the changes in consumer behavior post-COVID. You had this big boom during COVID as online education blossomed with some of your online higher ed homework help, and then a huge drop-off on the reopening. So what are you seeing right now? And what does it tell you about students and behaviors?
Yeah, there's a lot we're seeing, and you're right. So it was interesting because the help we got with COVID was more international, and in the U.S. was a lot of students needed help that they weren't able to get any other way. What happened, though, last October, November was about 1.5 million students just didn't go back to college. And that was sort of a shock, not something that we could have expected. So we've been digging out of a hole since then. But what we're seeing, at least this summer school, is we're seeing a stronger summer school than we expected. Historically, that's led to a better fall. We did not want to put that in our projections yet because we've been burned before. And we're seeing students tell us now that they're thinking about taking college 12 months a year rather than in semesters, so they can take fewer classes during a semester so they can work. And they take it over the summer where they could take less courses and do more hours. So all of those trends are good for higher ed and good for us if they follow through.
Right. I mean, this was a stock, Dan, that was, I don't have to tell you, more than $110 last year. Is now in the 20s. What are we going to see this fall? Because now we've had a whole year almost since kids weren't going back to college post-COVID.
Yeah, look, it's too early to predict, but the signs are stronger in that FAFSA applications are up nearly 5%. We're seeing 85% of the summer school students say they plan to or have already enrolled in the fall. And we're seeing significantly more students take summer school this year than last year because they're doing it online so they can both have a job and take classes. So that's all to Chegg's advantage if it continues to go that way. But as a company, at least as you know, Sarah, because you follow us for a long time in the education space, we're the only profitable company. We have great EBITDA margins that are improving. We produce 50% of our EBITDA or more goes to free cash flow, and we're growing the top line again. So the business is is in shape to take advantage of any significant upside.
Wanted to go broader with you, Dan, because you like to dish on other tech companies' happenings from your COO Yahoo days. I just mentioned the news of the day, which is the Softbank Vision Fund, one of its biggest losses ever there, almost $22 billion for the June quarter. And I'm just curious what you make of that. Obviously, they've had a lot of bad bets and technology has been hammered, but what kind of ripple effect that will have across Silicon Valley, VC, startups, because they were such a force.
Yeah, look, I'm one of the few people that actually worked for Masa. So one of Masa's first investments in the U.S. was Ziff Davis when I was there, and I spun out ZDNet, took it public under Masa and sold it to CNET, and then he had, of course, invested in Yahoo, where I went to Yahoo. So I've known Masa for a long time.
Oh, that's right.
Masa is only big bets. He does nothing that doesn't have giant risk. And when they win big. I mean, I remember with him one year when he became the richest person in the world next to Bill Gates. But when he loses, this is what happens. And I think people forget that there are ups and there are downs in the market. And so if you look at what SoftBank did, if you look at what Tiger did, they actually try to invent a new model, which is put as much money as you can in, raise the valuations as much as you possibly can, and then price out the second place person that couldn't get the money, like Lyft versus Uber. This has been his pattern for a long time. And WeWork, it's very clear that it doesn't work and it's not sustainable. So if you follow it, you got to get in and you got to get out fast. I just was never a believer in putting that much money behind these companies that didn't necessarily need it or would spend it in a way that would never produce a profitable business. So it disrupted the industry in a negative way. And I think this will bring the industry back to some normalcy.